what the new senior deduction really means for your retirement plan in 2025. Are you 65 or older and wondering how the new tax law could save you thousands in retirement? In today's video, we will unpack the new federal senior deduction and show you how to position your income so you keep more of what you earn in retirement. If you're a high income earner, this is especially for you. Hi, I'm Moise Piram with Asset Management Group. Before we dive in deep, make sure you subscribe to our channel so you don't miss any updates on all our latest videos on financial planning, retirement planning, tax planning, and wealth management. Beginning with the 2025 tax year, Americans who are 65 or older can claim a new additional federal deduction. It stacks on top of the regular standard deduction and the existing age-based increase. The amount is $6,000 per eligible person, which is $12,000 for a couple when both spouses are age 65 or older. The rule is on the books for tax years 2025 through 2028. It's temporary and not permanent, and you must actively claim it when you're filing your tax returns. It's not automatic. It does not repeal Social Security taxation, and let me repeat that, it does not repeal the Social Security taxation. The tax rules for Social Security haven't actually changed. What's changed is that this new deduction makes it much less likely you'll owe taxes on your benefits. The Social Security tax thresholds are still the same. For single filers, if your combined income is below $25,000, you pay no tax on your benefits. Between $25,000 and $34,000, up to 50% of your benefits can be taxed. And above $34,000, up to 85% of your benefits can be taxed. For married couples filing jointly, those cutoffs are $32,000 and $44,000. While the taxation rules haven't changed, about 88% of retirees will now pay no tax on their Social Security benefits due to this enhanced senior deduction combined with existing deductions. This mainly helps lower and middle income retirees who were close to these thresholds. Social Security taxation is based on what's called combined income. This includes all your income sources: wages, IRA withdrawals, Roth conversions, rental income, dividends, capital gains, pension payments, plus tax-free interest from municipal bonds, plus half of your Social Security benefits. So for example, if you have $20,000 withdrawn from your IRA, $8,000 in dividends, $5,000 in municipal bond interest, and $24,000 in Social Security benefits, your combined income would be $45,000. That puts you above the threshold where Social Security becomes taxable. But with strategic income management and this new deduction, you might be able to stay below those trigger points. The deduction is income sensitive. The full amount is available to those with $75,000 of modified adjusted gross income if you're a single filer, and if you're a married couple filing jointly, up to $150,000 of income. Above those marks, the deduction shrinks by 6 cents for every dollar of income until it phases out completely at $175,000 for single filers and $250,000 for joint filers. Well, first you must have a Social Security number, and it's not available for married couples who file separately. And you also have to be 65 or older by December 31st of the tax year. So to put it simply, your position inside those bands determine how much of the new deduction you actually get. Many households earning $200,000 or more will sit inside the phase-out or above it in some years. That does not make the deduction irrelevant though. Here's why it still matters. There's a direct tax savings. Even a partial deduction can save you significant money. If you're in a 24% tax bracket and get a $6,000 deduction, that's $1,440 in tax savings. And for couples getting a $10,000 deduction, that's $2,400 in savings. Now there's opportunities to manage your income, and the key is to manage your modified adjusted gross income with intention. When you can bring your income into those target zones through strategic planning, you maximize the deduction. And this means timing withdrawals from your IRA, Roth conversions, and capital gains, and strategically put them across the 4 years that this tax deduction is available. For high earners, your Social Security is likely already fully taxable regardless of the deduction. The benefit here is the direct tax reduction from this deduction itself, not changing how your Social Security is being taxed. Okay, so here are a few examples. So let's say you're age 70 and you're a single filer and you have an adjusted gross income of $80,000. The $6,000 deduction is reduced by 6% of the $5,000 you went above the threshold. That is a $300 reduction. So your net deduction equals $5,700. And at a 22% tax bracket, that's a savings of over $1,200. Let's say you're a married couple, 68 and 70, and you have an income of $160,000. We'll start with the $12,000 deduction, reduce it by 6% of the $10,000 you went above the threshold, which is a $600 reduction. So your net deduction equals $11,400. And at a 22% tax bracket, that's about a $2,500 saving. Let's say you're a high income earning couple with $220,000 of income. That gets a reduced deduction of $7,800. At a 24% tax bracket, that's still over $1,800 in tax savings. There are some moves you can make to plan accordingly. First, I'd say map out your income for each year 2025 through 2028. Identify your likely modified adjusted gross income band. For single filers, the full deduction band tops out at $75,000, and for couples, it's $150,000. If you are above the band, estimate the partial deduction using the 6-cent per dollar rule. Time your Roth conversions and traditional IRA withdrawals with care. Conversions increase your modified adjusted gross income and can push you deeper into the phase out. Consider smaller conversions over several years instead of a single large conversion in 1 year. The goal is to maximize the deduction benefit across all 4 years if possible. Use qualified charitable distributions from IRAs once you are 70 and a half. A QCD can satisfy part or all of your required minimum distributions while keeping that amount out of your adjusted gross income. This helps you stay in a better band for the deduction while meeting your giving goals. You can do strategic timing of your capital gains and other income. Since this deduction is temporary, consider bunching income in years when you're already above the phase out and keeping your income lower in years when you can benefit from the deduction. Consider income smoothing tools when appropriate. Some retirees will benefit from placing excess taxable cash into instruments that defer current income. Others will look at qualified longevity annuity contracts inside of a retirement plan to reduce future required distributions. These are specialized tools, and so before you do anything, I would evaluate your liquidity and the cost with your advisor and confirm your state rules. The new deduction is federal. Some states still tax Social Security while others do not. State thresholds and formulas can differ from federal rules, so check your state before finalizing your plan. Under the current law, the senior deduction applies to tax years 2025 through 2028. It is not automatic. You or your tax professional must claim it when filing your return. That means now is the right time to model your target income and set the moves for this year. So there's a 3-step action plan you can take. Step 1, run a side-by-side tax projection for 2025 with and without the deduction to see your potential savings. Step 2, set a household modified adjusted gross income target that maximizes your deduction benefit while meeting your cash needs and charitable and legacy goals. And step 3, choose 1 or 2 levers for this year. That might be the size of a Roth conversion, the timing of capital gains, or the use of qualified charitable distributions. The new senior deduction is not a silver bullet. It is a well-defined window that rewards precise income management. If you're a high income earner, the goal is to coordinate your income timing to maximize this temporary deduction benefit. Even partial deductions can mean hundreds or thousands in tax savings each year. Remember, this is a temporary opportunity running through 2028, so strategic planning across all 4 years is essential to maximize the total benefit. I hope this video was helpful to you, and subscribe to our channel. Also, follow us on social media. We have lots of videos on financial planning, tax planning, wealth management that come out and are released every week. I'm sure you don't want to miss them. See you next week, and until then, stay informed, stay empowered, and stay successful.